I don't think so. I just think as the companies become bigger and the end markets become just a little bit more mature, it's just harder to get that incremental subs. One of the positives about Netflix in the last print was that its most mature market, the U.S., arguably the most competitive streaming market, didn't see a dramatic slowdown. The issue is really in other parts of the world. So there's no question you got to spend a lot of money to stay in this business, and Netflix has to spend at least $18 billion a year, which they're doing. The business model allows it, but they're going to have to keep growing it. There's no easy margin relief out of this. If you're competing in streaming, you got to spend top dollar, and you've got to be willing to spend at least $10 billion a year, or else you're not going to be a player.
Even for Comcast, Julia, our parent company, there are investors who want to see NBCU separate from Comcast so that they can spend billions and billions and billions on Peacock, which Comcast investors don't want. They're here for other reasons.
But remember, Kelly, that Peacock is really playing a different game here than Netflix is. Netflix is about subscriber dollars. Peacock is about advertising dollars. And because Peacock also has a live component and it has news and is going to have the Olympics coming up, having news and sports is a different equation, and it keeps people coming back at a different cadence. I think there's something fascinating. I mean, just looking at the NFL ratings, at this idea that if you invest in live sports, you're going to have your subscribers or your viewers come back at a regular cadence. The pressure for something like services like Netflix is to make sure that they're investing in the type of original content that can make people feel like it's worth continuing to subscribe, even if they've just burned through a season of a show.
Right. And Mark, when we spoke to Laura Martin not long ago over at Needham, she said it was a mistake for Netflix not to own sports. I mean, if you think about it, as these channels proliferate, it's easier to be the tentpole home of a sports franchise that's going to be back year after year after year, isn't it?
Yeah, this is a tough one. And I wonder about what the next growth curve initiative for Netflix is going to be. And I know people like Laura Martin, very thoughtfully suggesting that they get into sports. The problem with sports is that it's not on demand. You watch the sports when the athletes and the organizations want to play. And whereas Netflix's appeal all over the years is that you can watch large amount of content pretty much on any device whenever you want. You can binge, or you can just snack on that series. So it changes the value prop. It's also a very competitive bidding space. I think the more interesting opportunity here for Netflix, and this is a change in my thinking too, is not in the U.S., but overseas. They're going to have to start introducing, if they really have started to mature out their paid subscriber base, they're going to need to introduce an ad-supported model. That's going to take them a couple of years to do, but that's what I'm watching for.
That's been her big call as well, saying they have to do that, Julia. I mean, does it make sense at some point? Because there's not every household can afford $15 a month for Netflix. For a lot, they say, I would happily pay $4 or $5 and, watch ads.
But look, and that's what's so interesting now is we just saw Netflix raise prices in the U.S., but they actually lowered prices in India because they've been struggling to compete there, where prices for rival services are relatively lower. But one of the bullish analyst notes that came out today said that they believe that, or I believe it was late last week, was that they believe that Netflix did have pricing power and could, continue to raise prices as they continue to invest in content. But I think what we have to see, Kelly, is as this year advances, how many subscription services people are going to want to pay for. If Netflix is going to be the go-to subscription service and people feel like it's going to be worth paying $20 a month at the high end, which are the other ones that may get lost in the shovel and people might be more willing to cut the cord with?
Mark, what would your parting advice for investors be as this all shakes out?
Well, on Netflix, I'm kind of in the middle now. I've after about a decade of having a buy on the stock, we downgraded it off earnings and just real concern over what's happened to the growth. And I don't think my guess is that we're no longer clipping along at 25 million subs. This was a wonderful stock as sub ads accelerated throughout last decade, best performing S&P 500 stock last decade. This decade, my guess now is that we're going to have decelerating sub ads every year. The number of new subs is going to be declining. I think that makes it much harder for the stock to outperform. It becomes much more of a tactical rather than a core long. So I'm steering clear of Netflix for now, and I look at other assets. I like assets like Spotify, for example, Google, Facebook, Amazon.
Spotify. I won't dwell there. We'll have that discussion another time. Guys, thank you both very much today. Mark Mahaney and Julia Boorstin talking on streaming.